Welcome to the deep dive. Today we're jumping straight into Seagate Technology's fiscal Q1 2026 results. Quite the quarter for them.
Yeah, a big one. Our focus today is getting you those key numbers, the drivers, and importantly, what they see coming next, fast.
Exactly. Okay, Q1 2026, the quarter ended October 3rd. Let's hit the highlights. Non-GAAP revenue was $2.63 billion.
Which is up, what, 21% year over year? A pretty solid jump.
Definitely. And the non-GAAP EPS, $2.61 per diluted share.
Okay, so let's put that in context. That revenue number, $2.63 billion, it beat the street's expectation, which is around $2.55 billion. So a nice beat there.
Right, they cleared that hurdle.
But the EPS, that $2.61, that really stands out. Analysts were looking for maybe $2.40.
So they didn't just beat it, they kind of crushed it.
They did, and crucially, it was above the high end of their own guidance. That signals really strong execution internally.
Yeah, CEO Dave Mosley pointed that out, right? Mentioned strong execution, robust demand, especially for the high-capacity stuff.
Exactly. The demand picture is clearly very healthy from their perspective.
Which brings us neatly to looking ahead. They gave guidance for fiscal Q2 2026. Seems like they expect this momentum to continue.
It certainly looks that way. For Q2, they're forecasting revenue of about $2.70 billion.
Okay.
And they give a range on that, plus or minus $100 million, which is standard.
And the bottom line, EPS guidance.
They're projecting non-GAAP diluted EPS of $2.75, plus or minus $0.20.
So sequential growth on both the top and bottom line. That's confidence.
It is. And underpinning that is the expectation of maintaining really strong profitability. The guidance anticipates a non-GAAP operating margin around 30% of revenue.
30% operating margin. Wow, that's pretty high.
It's very strong. It shows they expect to keep benefiting from that high-value product mix.
Now, you mentioned macro factors earlier. Did they talk about things like global taxes or tariffs? How does that fit into this guidance?
Good question. They were quite specific. The Q2 guidance includes their estimate for the impact of the new global minimum tax framework, Pillar 2.
Ah, right, Pillar 2. That's the 15% minimum corporate tax rate for large multinationals.
That's the one.
Yeah.
So they've already factored that complex change into their immediate forecast, which shows, well, a good handle on their finances.
And tariffs.
They said they expect minimal impact from global tariff policies in the quarter. So they seem to feel pretty well positioned against those major headwinds, at least for now.
Okay, let's dig into how they're achieving this.
Yeah.
The engine behind these numbers, profitability is, well, pretty stunning.
It really is. The non-GAAP gross margin hit a record 40.1%.
40.1%, up almost 7 percentage points year over year.
Yeah, 6.8 points to be precise. And the non-GAAP operating margin, you mentioned 30% for guidance, but in Q1 it was already 29.0%.
Which is up 8.6 percentage points compared to last year. That kind of margin expansion is huge.
It tells you they have pricing power, demand is high, supply might be constrained for these specific high-end drives, and customers are paying for it. That's directly linked to the cloud.
No question. Let's look at the revenue breakdown. Where did it come from?
It's almost entirely a data center story. That segment grew 34% year over year.
34%.
Reaching $2.1 billion. And get this, that's now 80% of their total revenue, just from the data center segment.
80%. So what about the other parts, like Edge IoT?
Well, that's the contrast.
Yeah.
Edge IoT revenue actually declined 12% year over year.
Interesting. So it's really all eggs in the data center basket right now, it seems.
It certainly looks like the focus, and the market seems okay with that, given the scale of the data center opportunity.
And we can see that scale in the shipment numbers. How much capacity are we talking about?
They shipped 182 exabytes of HDD capacity in the quarter.
182 exabytes. That's up 32% year over year.
Driven almost entirely by nearline drives. That specific category was up 39%.
And nearline is basically the workhorse storage for big data centers, right? High capacity, cost effective.
Exactly. Cloud providers, hyperscalers, they consume massive amounts of nearline storage.
And it's not just more drives, it's bigger drives too.
Right. The average capacity per drive increased 13% just from the previous quarter. It's now up to 14.6 terabytes on average.
So the demand is for density, more terabytes per drive.
Precisely. Which leads us directly to the technology enabling this. Mozaic HAMR.
Heat-assisted magnetic recording, the next-gen tech allowing much higher density. This seems critical to their success.
It's absolutely central. The big news here, and maybe the most important point, is that these Mozaic HAMR drives are now qualified with 5 of the world's largest cloud customers.
5 of the biggest hyperscalers have signed off on using these new drives. That's a massive endorsement.
It's huge. Qualification is a long, rigorous process. Getting that stamp of approval from 5 giants basically secures demand.
And they talked about visibility based on this, didn't they?
They did. They said nearline production is, quote, largely committed through calendar 2026.
Through the end of 2026, based on build-order contracts.
Exactly. Build to order, that changed the game. It reduces the historical boom-bust cycle risk in storage. They've committed demand locked in years out.
Incredible visibility. And why are these cloud players so hungry for this density? The CEO mentioned that AI transformation.
That's the connection. AI, large language models, machine learning, it all runs on data. Massive amounts of data that needs to be stored, accessed, processed.
Right.
AI inferencing especially needs these high-capacity nearline drives. You're constantly storing, checking, validating data for these training loops. Seagate is basically building the foundation layer for a lot of this AI infrastructure.
And they're not stopping with the current Mozaic tech, are they? There's another generation coming.
Already in the works. They mentioned Mosaic 4 plus ABMR drives.
Plus tech.
Yeah, the next step up. These are already in qualification with a second major cloud provider.
Already.
And they expect the initial volume ramp for these drives, which could go up to like 44 terabytes.
44 terabytes.
To start in the second half of fiscal 26. So maybe mid-calendar 2026 onwards. For both cloud and some edge uses, the innovation cycle is key to keeping those big customers hooked.
Makes sense. Okay, final piece. Financial health and shareholder returns. All this performance must be generating a lot of cash.
Oh, yeah, absolutely. Cash flow from operations was $532 million in Q1.
Solid.
And free cash flow, which is ops cash flow minus CapEx, came in at $427 million.
So strong cash generation even with investments. What about the balance sheet? Cash on hand.
They ended the quarter with $1.1 billion in cash and cash equivalents. Pretty healthy cushion.
So with that cash flow and cash position, what are they doing for shareholders?
They returned $182 million in Q1. That was through both dividends and some share buybacks.
Okay.
And importantly, the board approved a dividend increase, about 3%, taking the quarterly payout to 74 cents per share.
Raising the dividend now signals a lot of confidence in future cash flow, doesn't it?
It really does, especially when they're also investing heavily in ramping up this new HAMR technology.
And what about debt? How's the leverage looking?
Improving significantly. The total leverage ratio based on net debt dropped from 1.8 times last quarter down to 1.5 times this quarter.
So they're paying down debt or growing earnings faster than debt? Or both?
Mostly the latter. Earnings are growing very fast, which naturally improves the ratio. It shows the balance sheet is strengthening rapidly, reducing financial risk.
Okay, so pulling it all together, the big picture here seems to be record margins, strong guidance, all fueled by massive demand for high-capacity drives from cloud providers, underpinned by this Mozaic HAMR tech and, well, the whole AI boom.
That sums it up pretty well. The execution on AMR and the locked-in demand from hyperscalers is the core story, which leads to maybe a final thought for you, the listener, to consider.
Go ahead.
Given that Seagate says nearline capacity is largely committed through calendar 2026, based on these build-to-order deals, and given the relentless push for even denser AMR drives driven by AI, could this fundamentally change the storage industry's notorious cyclicality?
You mean, is the boom and bust cycle over for companies like Seagate, at least for the near term?
Or is it just being replaced by a different kind of cycle? Perhaps a sustained upcycle driven by these long-term cloud and AI infrastructure builds. It's something to think about how permanent this demand tailwind really is, given these structural shifts towards committed contracts and AI needs.
That's a great question. That visibility really does seem like a potential game changer. Definitely something to mull over. Thanks for breaking down Seagate's quarter with us.
My pleasure.
We'll catch you on the next deep dive.